Okay, good afternoon, everyone. We are going to work on chapter 4, accrual accounting concepts. So the first learning objective is explain the accrual basis of accounting and the reasons for adjusting entry. So there are two bases. Those are the main bases we are using. One is called cash basis of accounting. The other one is called accrual basis of accounting. Okay, so I'm going to explain the accrual basis of accounting and why we need for adjusting entries. So in last lecture, we have learned about generalizing, right? Generalizing to record economic events, right? And those are called accounting journal entries. Okay, so you do it when the event incurred, right? But at the very end of the fiscal year, on the last day of the fiscal year, we have to do a lot of other entries. Okay, those entries you do not do them at a regular date. You do it only on the year-end date, the last day of the fiscal year. So those entries called adjusting entries. The reason for that is this entries is going to make adjustment, right? It is going to make adjustment, okay? So accrual accounting, the main part, the adjusting entries, will be prepaid expenses, deferred revenue, accrued expenses, and accrued revenue. So those are the 4 categories for the adjusting entry. Okay, when we speak of adjusting entries, there are 4 categories: prepaid expenses, deferred revenues, accrued expenses, and accrued revenue. Okay, so and we are going to go through each category to learn what is this about and how we are going to make this adjusting entry. Well, after you make the adjusting entries, you would get a adjusted trial balance. Okay, so last lecture we learned about trial balance. So after you're posting these adjusting entries, you get adjusted trial balance, and based on the adjusted trial balance, you will prepare the financial statement. Okay, and then you are going to close the books with some closing entries. Closing entries. So I'm going to explain to you what the closing entries is about. Okay. Accrual accounting. Okay, accrual accounting. So users require financial information on a regular basis. Okay. So accounting divides the economic life of a business into time periods. Could be a year, quarter, or months. Okay, so 1 year period is known as a fiscal year. So shorter period, like a quarter or months, so that will be known as interim periods. Okay, so that is the reason why we are going to talk about accrual accounting. Okay, your business activity is continuous. It won't stop, right? From day one, the business started, it's just continue, right? It's just the activities are just continue. But at a certain point, you want to know, am I making money, right? So then you have to divide this economic life into time periods, right? So then you can gather the information about a certain time period, right? And that time period financial information will be useful to the users, right? To the users. If you are the boss, right, you want to see within that time period, am I making money or not, right? If you realize you are losing money, and then why you keep running the business, right? Probably the better idea is to close the business. So you want to divide the economic life of the business into time periods. A 1 year, 12 months period is known as a fiscal year. So a fiscal year doesn't have to follow calendar year. Okay, a fiscal year can be any period with 12 months, right? So for example, your fiscal year can start with May 1st, okay, and ends April 30th of the next year, right? So as long as that fiscal period has 12 months, that's good, right? It doesn't have to follow the calendar year from January to December, okay? So often at the year end, the few months after year end, you have to prepare the accounting, right, to get everything ready so that you are able to file your tax return to CRA, right? So normally people would avoid their fiscal year end in their busy season, right? So if you are a tree nursery business, or let's say you are a tree nursery business, you are growing the pine trees for Christmas, right? The Christmas trees. So the busy season for the business would be around December, right? That's the time people are buying these Christmas trees, right? Get ready for the holiday. So those type of business, they should avoid a fiscal year end in December, right? Because they're busy with their business, and there are lots of activities going on, lots of revenues, costs, right, going on. So if you pick that time as your fiscal year end, you're going to have a lot of work on the accounting side, right? So people will try to avoid fiscal year end in their busy season. So the smart business entrepreneur will pick their slow season, right? That time would be their fiscal year end. Okay. So that'll be one of the logic to think about how should I determine the 12 months period, right? Okay. Bigger business, larger operations, they probably need to have informations on a timely basis, right? Quicker, probably monthly, quarterly, right? So the monthly, quarterly, those will be considered as interim periods, right? It's the time period within a fiscal year. So that's the interim periods. Okay. Many transactions affect more than one time period, right? So many times that when you have a transaction, you can affect more than one time period, right? So for example, on the day before the fiscal year end, okay, you made a purchase, right? But you didn't pay for it, right? You didn't pay for it until the next fiscal year start, right? So that transaction, okay, that effect is crossing two fiscal period. They made a purchase at the first fiscal year, but then they made the payment on the second fiscal year, right? You can see that that event actually spanned over two fiscal years, right? So that's what they mean. Transactions can affect more than one time period, okay? Accrual-based accounting, transactions affecting a company's financial statement are recorded in the period that event occurred, rather than cash is received or paid. So that's the key. So when you are recording the transaction, right, you have a purchase date, you have a payment date, right? And they are in different fiscal period, right? And they belong to their financial. It means that it matters when you are going to record the event, right? Because it's two fiscal period. So that information will be collected either or, right? So the idea here is you record the event, the transaction, when the event occurs, rather than when the cash is received or paid. Okay? Revenue is recorded when earned, even if cash has not been received. Okay? So if you go to a superstore, right? You go to superstore, you buy a grocery, okay? And you use your credit card, right? So that's not a cash payment, right? So you buy the grocery and you tap your credit card on the machine and you hear beep, right? And then that transaction is completed. So the revenue will be recorded on the superstore side. Superstore will recognize they made the sales to a customer, okay? But they haven't received the cash yet, right? Because the cash is going to take some time, right, for the credit card company to collecting the cash and pay to the superstore, right? So the event occurred. So when that revenue is recorded is when that sales event occur, right, at the point of the sale. So revenue is recorded at that time, even though the cash has not been received. Okay? Similar idea, expenses are recorded when goods or service are consumed or used rather than when cash is paid. Okay? Rather than cash is paid. So only when the goods or service are consumed or service or used, that's the time you recognize the expenses, right? Not because you pay the money, right? So for example, you paid tuition to university, right? You pay the cash at the beginning of the semester. Okay? Would you recognize all the payment as your tuition expenses? Even though you haven't consumed the service yet. You haven't learned the knowledge from your instructor yet. At the very beginning of the semester, okay, you pay upfront the tuition fee, but you haven't consumed the service provided by university yet, right? So even you pay the cash, but you should not recognize the expenses, right? Until you finish the semester, right? You have learned a lot from the instructor, right? So this is what we are saying. So when the event occur, okay, that timing may not be the same timing as the cash flow, right? Either you receive cash or you use cash, right? So that could be separate. Sometimes they are together, right? If you pay the cash to the superstore, right? They recognize revenue, and at the same time, it's the cash payment, right? But other times, the timing may be different from those cash flows versus the event occurrence, right? So you recognize the transaction when event occurred, not when the cash flow happened. Okay? That is accrual-based accounting. Okay? So in contrast, what is the cash-based accounting? Well, revenue is recorded only when the cash is received. Expenses are recorded only when cash is paid. Okay, so if you are using cash basis of accounting, your journal entries, each journal entries, you have to debit or credit cash, right? Because that's the time you recognize revenue expenses. So under the cash basis accounting, for each journal entries, you either debit the cash if you receive cash, or you credit cash if you use cash. Okay. It can lead to misleading information for decision making, right? So, for example, okay, I'll tell you how this can be misleading, right? So this year, I make $1 million revenue. My expenses is only $500,000. Okay. So I have a net income of $500,000, and for which I'm going to pay a lot of tax. Okay. So then I think, oh, I don't want to pay that much tax. What should I do, right? Okay, so maybe if I increase my expenses, that will reduce my net income, and that will reduce my tax, right? So how can I increase my expenses? Well, your expenses are recorded when cash is paid. So guess what? I'm going to pay, let's say I'm going to pay a supplier $300,000 for work to be done next year. Okay, so I pay them money, they will deliver their service next fiscal year. But I made the cash payment this year, right? Under cash basis accounting, because you pay the cash this year, you recognize the expenses this year. So you recognize that $300,000 expenses. And so my net income will be reduced by the amount. And now it's from $500,000 to $200,000. See how much tax I'm saving, right? So that's why we are talking about here. If you use cash-based accounting, it can lead to misleading information for decision making. Okay. Revenue and expenses can be manipulated by timing the receipt and the payment of cash. I just give you that example of manipulation, right? If I'm able to timing my cash payments, cash receipt to recognize revenue expenses, I'm manipulating my net income, right? Okay, does anyone have any questions so far? In terms of accrual basis accounting versus cash based accounting. Does anyone have any question? No question? If you understand everything, please give me a sum up. 1, 2, 3. Okay, awesome. So I will move on. Revenue recognition. Okay, revenue recognition. Revenue, okay, revenue will increase the assets or settlement of liability. Okay, and the revenue is the outcome from the company's normal activities. Okay, if I'm a CPA accounting firm, I'm going to earn service revenue, and that's the outcome of my company helping clients do their bookkeepings, file their tax returns. Those are the normal activities. In general, revenue is recognized, okay, if it's a merchandising company. So the revenue is recognized when merchandise is sold and delivered the point of sale. So merchandising company selling goods, right? So if you think about Superstore, Costco, they are a merchandising company, right? And the retailers, right? They are merchandising companies because they are selling stuff, right? So when do you recognize the revenue? Okay, the customer pay you $100. At what point you should record the revenue of $100, debit, accounts receivable or cash for 100, credit revenue, sales revenue for 100, right? The question is the timing, right? When do you record this sales event, right? So in general, okay, if it's a merchandising company, when the merchandise is sold, okay, so that will be you buying something from grocery store. The point you check it out from the cashier. That's the time the company, the merchandising company, will recognize the revenue. Or if let's say it's a big furniture, it won't fit into your car, so you ordered online. So when the company delivered that big couch sofa into your house, right? At the point of the delivery, right? Then they can recognize the revenue. And service company, right? For service company, it would be accounting firm, lawyers, right? Doctors, professional services, right? So for service company, maybe they don't give you stuff, right? They don't sell you goods, right? Maybe cleaning job, or maybe massaging, right? They are performing a service, or hairdresser, right? They just do a service. They are not selling you something, right? They will do a service for you, right? So for those companies, revenue is recognized when the service is performed, right? The minute the hairdresser finish my hair, right? They cut my hair, they finished the service, they are able to recognize the revenue. Not halfway through, right? Not like they only cut, half of the hair and then they won't recognize revenue, right? Um, uh, Speaking of hair, over the years, maybe I'm working too hard, use my brain too much. I'm experiencing like a very serious problem is the hair loss, right? The hair loss. 20 years ago, when I first came to Canada, I have lots of hair, and now my hair is very thin. And but that's what a professor supposed to look like, right? If you are a professor, you should not have thick hairs, okay? And your hairs should be fluffy. So the point I was making is, I think if I walked into a barber shop, I think they'll be very happy because they make the same amount of money, but they're not too many work, right? They only take them probably like 5 minutes to cut all my hair, right? So it's a good business for them. So for service company, they have to perform the service. For the merchandise company, they have to deliver the goods to you. Okay. So under ASB, this is the accounting standard used for this is ASB means accounting standard for private enterprises, not for the public listed companies on the stock exchange market. Okay. So this one, revenue can be recognized when service has been provided, or the risks and the rewards of ownership of the goods have been transferred to the buyer. Revenue can be reliably measured. Collection is reasonably certain, right? So first, service delivered, the goods are transferred, and then the revenue has to be reliably measured, right? Because otherwise, if revenue cannot be reliably measured, when you are making the journal entry, which dollar amount you are going to put. If you put a number there that is not reliable, what's the point to make the journal entry? collection is reasonably certain. If you know that you are not able to collect it, right? If you know that you made mistakes, you sell these things to the wrong person, there's no way you are able to collect it. So if that collection of money is uncertain, why would you record it? Right? So it's only when the three conditions are satisfied, you have performed the service, they all deliver the goods, and you have a reasonably measure of the amount of revenue, and you know that the collection on that amount is reasonably certain. I know you may not like the word. What do you mean by reasonably, right? What's the percentage of that? What do you mean by reliably, right? So accounting sometimes use all these kind of languages, right? Because it is a gray kind of area. It requires professional judgment, and that is why there is a designation called a CPA, right? Because if you are designated accountants, you should be able to exercise your judgment. What kind of situations you have to make a judgment call. Is this reliably measured? Is this reasonably certain? Right? Under IFRS, international IFRS is for the public listed company, right? If you buy a stock from the stock exchange market, so those companies are public listed company, and they have to follow IFRS, International Financial Reporting Standard. So at this time, the revenue are recognized when company satisfied a performance obligation, and they used a five-step process to measure and report revenue. First, is there a contract? It doesn't have to be a written contract. It'll be funny every time you walk into a superstore and you have to sign on the contract saying, okay, I'm coming, okay? I'm going to walk into your store and I'm going possibly will buy certain amount of groceries that is going to worth this much money. No, that's not what happened in the practice, right? So here, the contract doesn't have to be always written contract. It could be implied contract. So if a customer walked into the superstore, and they walk around shopping, that is an implied contract between the client and the customer. Second is identify the performance obligations in the contract, right? So for the grocery shopping, superstore has a performance obligation, which is to sell the goods to the customer, deliver the groceries to the customer. That's the performance obligation. Determine the transaction price, depending how much you buy, what are the things you buy, there's a price tag, right? Allocate the transaction price to performance obligations in the contract. So these are the situations that one contract could have different requirement, different obligations, but there's only one price for the contract. So this one is mostly for the intermediate financial accounting, right? I taught intermediate financial accounting. So like this slide, we can spend 4 hours on this, okay? But for this course, I'm not going to go into all those details, right? Maybe you should just know that it's a 5-step process to measure and report revenue. Does anyone have any question about revenue recognition? Revenue recognition is probably one of the most challenging topics in accounting domain, and it's always tested in different exams, including the CPA exams. So revenue recognition is very important, very heavy. Yeah. Does anyone have any questions here about revenue recognition? If you understand what I'm saying, give me a sum up. 1, 2, 3. Okay, awesome. So expenses recognition. expenses are recognized or recorded when a decrease in economic resources occur. Okay, so it could be the asset are consumed, right? All the liabilities incurred. So if I go for massage, right? So I pay massaging fee, that's the expenses for me. But why? Because my asset decreased, right? So my cash level decreased because I use some of my cash to buy that massaging service, right? As a result of this massage expenses, my cash, my cash, my asset are consumed, right? Or if I don't have money to pay them right away, I would speak nicely to them. Okay, can I pay you later? Right? It's become accounts payable. So either you consume your asset or you increase your liability, right? So those are the time you actually will recognize the expenses because it is a decrease in the economic resources. Okay. These expenses are due to company's ordinary revenue generating activity. Okay. So I'm an accounting firm. I will buy accounting software, right? So if I want to make that accounting revenue, well, that's too bad. I have to have accounting softwares to help me do the work efficiently, right? Effectively, more accurately, right? So that's just software expenses is just part of the business, right? You want to generate revenue, you want to make money through the business, you have to incur those expenses. Okay, and expenses revenue tied recognition tied to changes in asset liability, right? So will be if you recognize expenses, either my asset will decrease or my liability will increase, right? Often coincide with revenue recognition. So in accounting, we call this matching principle, right? You earn a money, that's the revenue, but this revenue doesn't earn without any cost, right? So then you match that revenue with the corresponding cost expenses. So revenue recognition often goes together with expenses recognition, right? So revenue recognition often goes with together side by side by the expenses recognition because you know you incur the expenses, right? You incur the expenses to earn the revenue. Otherwise, you can't, right? If I don't pay salary expenses, how my employee will be willing to work for me to earn money, right? To earn the revenue from the customer. Okay, so need for adjusting entries. So entries made at the end, this is the keyword, right? The last day of the fiscal year, which is the year end. So entries made at the end of the accounting period to update accounts and produce up-to-date and relevant financial information. Okay, so on the last day of the fiscal year, we needed to make entries to update all these accounts so that they reflect the most current financial information. Why we have to make all these updates, right? Why? Because the trial balance may not be complete. Some events are not recorded daily. For example, you want to recognize the depreciation expenses on the equipment on the computer, right? So those depreciation entries will be done only once a year. You don't do it on daily, right? What's the point to do it on daily, right? So you don't do that. You only make one time entry on the year end to recognize the wear out of your equipment, buildings, asset, right? Because you use them to generate revenue. And the cost of it is that your asset is worn out, getting older, getting obsolete, right? So that cost of using the asset is expenses, right? So that depreciation expenses is recognized only once a year, right? So it was not reflected in the trial balance. So you have to do it on the last day of the fiscal year. Some costs are not recorded during the accounting period as they expire due to the passage of time. Okay, so some costs are not recorded during the accounting period as they expire due to the passage of time. Okay, so for example, you pay the rent, right? You pay the rent. Let's say the commercial business, they pay the whole year rent upfront, right? Okay, so they didn't recorded rental expenses every month. At the very beginning of the year, they make one payment for the whole year. So that general entry is you debit prepaid rent, credit cash. But then after that, time goes by, you move closer to the last year, the last day of the year end, right? The last day of the fiscal year. So you didn't record rent expenses for every month, right? So now at the fiscal year end, you have to recognize the rental expenses, right? The last point here, some items may be unrecorded because their amounts are unknown. Okay, so let's say your last day of year end is the last day of fiscal year is December 31st. Okay, and you know that you have to pay utility expenses, right? You have to pay the utility company the expenses for using electricity, water, and natural gas, right? So you know you have utility expenses for December, but guess what? You don't know how much you are owing because you only receive the bill in January next year, right? So on December 31st, you don't even know what is that amount, right? Before December, in the month of December, you didn't receive the bill. You don't know what is the amount. How can you make that journal entry, right? So you have to make it after, right? So those are the reasons why the trial balance throughout the fiscal year, that journal entry might not be complete to reflect all the transactions. So you will have to make this adjustment on the last day of the fiscal year, the year end, okay? Does this make sense? Does anyone have any question? Nobody have any question? Okay, I'll move on. And then the types of adjusting entries will be prepayment. So that there are two subcategories: prepaid expenses, deferred revenue, accruals, accrued expenses, and accrued revenue. Okay, so in the next learning objectives, I'm going to talk more about these four categories. Okay, so stop recording.